In this session, we're going to talk about one critical mistake to avoid and 2 strategies to lock in your gains. Now, so the first mistake is you're told to let your winners run and cut your losses quickly. That's an old adage, because if you let your winners run, does it ever go lower? Well, this is how the market is. It's up, down, all around, and when do you, if you follow this, like when do you get off and when do you get back in? So purposely, it's complicating, and it's easier when someone says just let your winners run and just cut your losses quickly. Well, it doesn't work that way. Last year, Roku was up 322%. I mean, that line is pretty straight that I drew, but that chart, it's a pretty up and down chart. I mean, where do you buy and where do you sell? Shopify, another top performer, 193%. Same thing here. At the top there, and it dips down, where do you cut your losses at? It's hard to know. I mean, it's buy and hold, or so that's a mistake that a lot of people fall into, is that they fall into like just cut your losses quickly, but then if they do, then it goes in the other direction. It's a bugaboo. It's a trick. It's a mind game that happens. Same thing with Trade Desk, up 134%. That's a lot of volatility here. Sure, it was up 134%, but when you look at this, if you're a normal, ordinary investor, which we all are, some of us a lot more beginning, what do we do here? Well, one thing that we could look at that not a lot of people know about is every move, there's an expected move. And this is where the options market goes hand in hand with equities being stocks. The equities market provides an outlook on the expected move. So this right here, it's a lot of information, right? Typically, you don't want a slide with all this information, but this is an option chain. This is the SPY. This is from Friday's close, but you see all those options there. This is why people stay away from options. That's a lot of options, right? Got weekly, weekly, weekly. But let's ignore that right now. Let's just talk about this on this chart, on this side here. On Thinkorswim, this is what I'm looking at, this platform here. It's an online brokerage. These numbers here indicate the expected move or the expected range. That's what expected move is. The expected range the market expects the SPY to move. If we look at the options that expire 10 days, so 4 down. 10 days, February 16th, 2020, the expected move for the next 10 days in the SPY is $5.80, higher or lower. That's what that means. So we use the options market to help us understand what we can expect in the equity market. If that goes lower, if it goes $5.80 lower, well, we know that. We don't cut our losses. Why? Because that's what the market priced in. So it gives you a framework to start to build off of and understand what expectations you have going into a position. If you just open up, if you bought SPY today, like what does a new investor do? You buy the SPY, which is the Spider S&P 500. Well, in the next 10 days, you can expect that price fluctuation is going to be higher or lower, $5.80. Now, if we go all the way down to the bottom here, we have a 44-point expected move up and down, and that's all the way into December of this year, the end of December, 210 days, 214. So we have an expected range where we can look at probabilities. This is all probability based. Options are based on probabilities. The market is based on probabilities. When you say just cut your losses and that's your winner's ride, it doesn't work because everything's probability based. And we understand the expected ranges that we can see, we can start to feel better about what we're doing and if we're doing it the wrong way. So here's another platform as well, and it's the same thing. Not all platforms have this, but most platforms are offering this. And this is just taking the option chain, and I call it almost under market. It's just, no one's going to open up typically the option chain, but this is where you can get all this information. It unlocks a whole new level of understanding the financial markets. It is a lot more complicated. It is a lot more in depth, but when you're putting money to work, putting risk out, you need to know what to expect and have a better understanding. And the options market, which trades actively, provides that information because they're all traded, bought and sold. They create these probabilities and these expected moves. So one thing I always talk about, we've heard the old adage, buy and hold, but it's buy, manage, and hold. If we buy and we manage our expectations, manage what we are looking to do, we take profits and we hold. Holding means managing what I expect to happen and be able to feel comfortable about what tomorrow is going to bring. So every product is not different. A lot of people who start, it typically is to start with mutual funds and then go into stocks and then go into options. Well, what happens is that especially when you take the level from going to stock to options, it's like a Corolla to fast cars. These exotic cars do not drive the same way as this Corolla does. And that's how stocks are. And what happens is that you take something like cut your losses quickly, or this framework that you take from stocks, and then you start to apply it to different products. And every product is different. And that's one thing to take away, that options are derivatives of an equity and they trade differently. If you take the adage of what we started with of cut your losses quickly, well, you're going to get you're going to get knocked out of options a lot quicker because they don't trade how stocks trade. They're a vehicle. They're a different way that they trade. And it's understanding that every product is different based on that. Bonds trade differently. Every product is different. You got to treat them differently as well, just like how these cars are. Every car is different, and they feel different when you drive them. So one of the things that we often talk about, or you'll hear, is it better to buy or sell options? Now, this is a little bit more advanced for those that are active in options. A lot of times people think that selling options is better. And sometimes people think it's buying options. Well, this is where we start to develop framework and a plan. This is where we start to go a little bit deep. And this is where, to be successful, you got to start building a foundation on how you, one, manage expectations, and two, how to create success in the long run. So with options, it's important because, again, every vehicle is different, especially with a leveraged product. We got to treat it differently, and we got to find a framework. With options, you want to manage and create a framework to create success. So this is going to help avoid a lot of the problems of buying an option, losing money on it, and getting discouraged. Because if you have a framework that you could start that creates success that you know, well, it's going to put you in the right direction starting out. So what we're looking at here is, as we looked on that previous option chain, there's a lot of options. Those are expirations. So what we're looking at is an option, every contract of an option expires, has an expiration date. Some of those expired 2 days, some of those expired 45 days, and we looked at those Decembers. Those expired 264 days. These expire in 45 days. What we're looking at is an expiration of 45 days. The reason for 45 days with options is because the decay on options accelerate in a shorter time. And a delta is just the options have different deltas. And what we're looking at on this one is selling a put, and this is an out of the money put. And by selling a put, we're collecting premium. That's the benefit. So an option buyer pays, an option seller collects. So selling a put, collecting premium, 45 days out on a 30 delta. This is the return. What we're comparing this to is owning SPY stock versus doing that approach, selling that put. So the blue line is the selling of the put. The blue line, or the purple line, is just owning shares of SPY, the ETF. So the performance is much different over this 10-year time frame. So the things that we want to look at compared to, this is comparing the stock performance or the performance of owning shares versus just this framework of puts. And the benefit of options is that you use a lot less capital versus owning shares. So at certain times and at all the time of that framework of selling that contract, we risked $2,000. The total return was 8,670%, which is an overall percent return of 433. The average return is 5.6, and the thing that is very important for a lot of individuals starting out, especially with options, is win rate. It's tough to lose and still continue to try to do it if you're not sure that the next trade is not going to lose. So high win rates is something a lot of individuals like to start out with. That's why a lot of people gravitate to selling puts, because of the high win rate. So we had 72 wins and 11 losses. And the stock performance over that time was 280%. But again, you had to own shares. You had to buy shares at $107 and then you sold them at $333. The amount of capital is much greater to own shares versus this. So you have a lot less risk and you made a lot more of a return. So what we start to do here is we start to build on layers. This becomes more engagement, but we're able to create better returns by having a better framework. So everything's the same, except for now what we're doing here is, again, if we have a 45-day window, what we're doing is that if at 21 days we don't make a gain of 50%, then we close it out or we're taking gains at 50%. So it's either or. And then we open the next trade immediately. So what we're looking at here is, did it perform better than the original app? So what we're building on is building more engagement, being more engaged with your money, understanding different products and expectations. We can start to build better performance overall. It requires a lot more work and understanding of everything, but the returns are going to change your account based off of just owning shares versus just following this framework. The performance is much greater, which allows you to do more things. So I believe it's 600% here, and the win rate went up to 89%. So we originally had 86 on the other one, but by adding those other triggers, or a lot of people, the thing now is recipes. Everything's about a recipe. So baking the cake, we have a better recipe. Our cake tastes a little bit better here. 196 wins and 24 losses. So that's over 200 trades. Compared to just buy and hold, which was 280%, if you were a little bit more engaged and active, you took profits and you made that type of return. Now, if we bought an option, and this is the great debate, buying options lose money. You only want to sell puts. That's a lot of people's arguments. But what matters is what the numbers say. So if we did something similar where we bought an option 30 days to expire and we bought a 50 delta, the performance on that was 2,500% compared to the SPY, which is down at the bottom here. So which one's better so far? Is it selling puts or is it buying calls? Well, if we isolate one, we could say, well, it's buying calls, but obviously that's hindsight. What I'm trying to guide people into is to understand that it's about diversification, because we can't just lean on one. You don't want to just lean on one approach. This is best case scenario. But if we are creating more engagement by buying or selling, no matter what, with a framework, we can outperform or create better performance than just owning shares. On this one, it's a little bit different though. Remember I talked about the win rate. The win rate on this one's 52%. That means 1 for 1. That means you put on one, it's a coin flip on the fact of if this trade's going to make money. That's tough when you do that. So you lose on one trade and then you need to follow that system and be able to then deploy more capital, where a lot of people at this time are going to say, I don't want to get into the next trade. But if you don't, the numbers show that you need to. But if you do, the return on that's 2,700%. That's the trouble. And again, managing expectations of understanding the numbers and also the overall expectation when you deploy risk. The only time you can control risk in the marketplace is before entering the market. There's no such a stop loss or any of that stuff is off the books because you can't control that. The market could freeze up crash, and that risk, that stop loss crashes through it. So the only time you can manage risk is before entry. So if you understand the numbers and understand what you're doing, you have a better understanding of what is going to be the outcome. So on this one, we have a really great win percentage. But if we start to build on this one a little bit more, talking about the gains of 50% and open the next trade immediately, the return on this one is 3,000%. So we added another layer. And what that means with managing 50% is that if I buy an option at $1 and it goes to 150, I'm closing the trade and opening up a new one. The same thing would be with selling a put. If I sold that put for $1 because I collected that premium, I would close that when I collected 50 cents. So I would sell it, I would exit that at 50 cents. So that would be the difference of that. That is managing expectations. That's understanding that I can't just let my winner ride here because options don't work that way. I also know that cutting my losses aren't going to work out that way either. It's just managing what I have and be able to follow parameters that are going to put me in the best light to succeed. So on this one, we increased the win rate to 66%. It's a lot of numbers, but it's understanding that if you use a product, it's all probability based. It's math and numbers at the end of the day. When we look at the financial markets, money flows into the financial markets and there's a natural drift higher. And the reason why is because if I'm managing your money, I'm going to take your money and I'm just going to put it in the marketplace. I don't make money as a professional if your money's not invested. So that's where the natural drift comes into play. So the natural drift in the financial markets is typically about 53% of the time the markets go higher. Markets fall faster because of fear. And they take the escalator up. So with this one, we increased it to 66%. Still good. It's better than a coin flip. But it's a lot of activity. You have to keep maintaining it. You got to keep engagement to keep getting those kind of returns. But again, the more returns that you get, the better the returns. Typically, it's going to be the more engagement or more activity that you have to. So that's where, again, it's buy, manage, and hold. You're buying, you're managing, and you're holding. And that's the key ingredient that a lot of individuals are not familiar with, is this managing expectations, managing profits, and not just thinking that you're going to be able to cut a loss out, because losses are part of it. Even at 66%, there's still a 40% chance of losing money. That's just part of it. But if you know the outcome over the long run is going to favor you, then that's where you can manage and still push through it. So this one's going to be very complicated. Being that, building off of options here, the SEC has a rule with pattern day trading. It started in the .com, and if you're under 25,000, you can only place a certain amount of trades, 3 trades every week, 5 days. Well, when you're trying to the more active you are, which we saw creates more profits, they restrict that because you can only do so much. So how can somebody get to that, past that 25 level, if they can't manage it and you're restricted by it? So this is one way to be able to get around it. It's also one way to kind of be able to let your lock in profits and be able to let those winners ride, but ride in a way that's going to benefit you without having to lose. So I call it the guaranteed profit multiplier. What we're doing here is selling an out of the money option for a net credit higher than the premium paid on what we already have on an existing position. I have a couple of examples here, but once that happens, what we'll do is, if it continues to go in our direction, we'll be able to exit the spread for higher profits. But at that same time, we've already locked in our profits. So this is a chart, purposely put it here. This is ZNGA, Zanga. And if you look at this, it's all over the place. Here's the option of it. So this is what I mean by understanding the product. If you traded the option, an option on it, and you traded the stock, mean, they trade differently. They're just different products. So this is the stock, and this is a 4-hour chart. And this is a 4-hour chart of an option, and this is a Zynga option. And I'm purposely setting this up. So you can see here it goes higher. So this is what I mean, especially with options. If you let your winners run here, it quickly comes back down. And for those that are trying to get involved with options, this is the frustrating part. You quickly get a profit, and it quickly goes away. That's the frustrating thing. It's frustrating for me as well. You go from 60 cents all the way to $1.53, all the way back down to 56, back up to $1.20. Options are great, but they're also fickle. So this is part of my service. This is a service that I provide. And I just wanted to use real examples here. But this is, we published this on the 27th, and here's the recommendation. We're buying to open the Zynga June 19, 2026 call for 63 cents. So we're paying 63 cents per contract to open. Again, that was on the 27th. So we go back here. I don't think it's on this chart here. So we go back there, and you could see, like, why is he buying? Well, getting in is always, there's many reasons to get in. It's just how you get out. Again, managing expectations. Here's the option. So we get the option here, and then now up here, we're making money. Do we let this ride? Well, no, because we're not managing our profits. We're not managing our expectations. So one way we can avoid knowing what's going to happen here, well, obviously this is in hindsight. We know that it's going to crash down. It could continue to go higher, but how do we know that? We don't know that. We have to understand how products work. So what we do here is, if you think that it's going to go higher, the best way to lock in these profits is by selling a call against it. So we are already long here. So what we're looking at is an option chain here. What we're looking at is the green is the open position. The red is the sold position. So on the 27th, it was open, and on the 6th, this is me selling that call against it. What we're trying to do here is, originally we paid 63 cents for it. Now, if we can sell the 63 cents, and if you look at the June 6th right above that blue line, they're trading at $1. This is closing prices. They're trading at $1.106. Now, ideally, we would want to be able to sell that next strike, that 7th strike, at the same price or higher. And if we do, we create a spread, a dollar debit spread, with prices still at $6.65, we still have opportunity for that to continue to go higher. So by selling that call, we have locked in profit, and we also can provide opportunity to create more money. Now, if it doesn't, that's fine. It just expires, and we've already sold it, we collected it, we already have that money. This is a way to use it without, one, using extra trades if you're under 25,000, which is a pattern day trader rule, and two, to be able to, let's say, be able to have more profit opportunity if you thought prices were going to go higher. So this is a chart of CLVS. It's another volatile stock. It went from $2 all the way up to 17. And again, let your winners run, but then it comes back down. You have to manage. Here's an option of CLVS as well. It's very volatile. So this was on the 3rd of February, where we emailed this out to our readers here. And what we're doing is we're buying the March 10 call for 85 cents. So a few days later, after buying this, over here, so we're looking at a daily chart, prices were here and they popped up to there. Well, the options, we looked at the option as well. The options were trading down there, and then all of a sudden they popped up higher. Well, they went from 85 cents all the way to $1.98. Again, let your winners run, cut your losses. Well, for these types of products, it's hard to do that. But if we managed it, as I was discussing, we bought it 85 cents on the 3rd. A couple days later, on the 6th, those contracts are trading the 10 calls are trading at $1, it looks like $1.55 they closed at, $1.60. So we're up on the trade. It's about it's 100% win. Now, if we look at that next strike, the next out of the money, well, those are trading at $1.25. If we sold those, we guarantee $1.25. So we have guaranteed, so $1.25 minus 85, that's the profit that we've captured already. If nothing else happens, if we sold it there and that happened, where it comes back down, we've locked in our profit. However, if this continued to go higher, with that spread, we have profit opportunity all the way up to $11, which is another 90 cents higher. So again, we can let our winners run, but we've locked in our profits here. So it's very advanced stuff, but this is the kind of active management that is required to be able to create alpha and create and generate better returns. So to recap on what we're discussing here with that, it's a lot to talk about, is we're selling an out of the money option. We already have an option that we're long. It's now profitable. What do we do? Do we exit or do we let it continue higher? Well, one option we can do is sell a call against it to create a spread and get the premium, take the profit, and let it continue. If it doesn't, no big deal. And if it does, even better. But that would be one way that a lot of people are not familiar with on how to use options directionally, be able to lock in those profits and create a spread and then be able to exit higher if it does go higher to have more profit.